Welcome to the SchiffGold Friday Gold Wrap, your overview of this week's precious metals news. It's Friday, October 27th. I'm your host, Mike Maharrey. Thanks for tuning in. Gold touched its lowest level in about 3 weeks this morning, pushed down by a strengthening dollar, or more accurately, a weakening euro. The EU currency tanked after the European Central Bank announced an extension of its quantitative easing program. More on that in just a moment. The dollar traded at a 3-month high against a basket of major currencies this week, adding pressure on gold as it makes dollar-priced commodities costlier for non-US investors. As I'm recording this, gold is currently trading at $1271.10, silver is at $1680, and the silver-gold ratio stands at 76.0. Despite the dip in the gold price over the last couple of weeks, ABN AMRO released a report bullish on the yellow metal. The Dutch bank projects the dollar will decline next year and boost gold. Quote, the longer-term trend in gold prices is positive, mainly because we are negative on the U.S. dollar. Our forecast for the end of 2018 is USD $1,450 per ounce, end quote. Despite some strength in recent weeks, based on expectations of a Federal Reserve rate hike in December, and the launch of a program to shrink the central bank's balance sheet, along with speculation about who will take the reins at the Fed, the dollar has been on a generally downward trend this year. Peter Schiff has said he thinks the next crisis will be a currency crisis, with the dollar plunging into the cellar. There's been a lot of focus on the Federal Reserve over the last several months, especially expectations that it will continue interest rate normalization. Sometimes it's easy to forget the Fed isn't the only game in town. While most people consider QE dead and buried in the U.S., it remains alive and kicking in other parts of the world. Yesterday's European Central Bank announcement that it will continue its bond buying program deep into 2018 means easy money will continue to flow into the European Union, even if the Fed turns off the spigot in the U.S. ECB President Mario Draghi said the central bank would cut its bond purchases in half beginning in January, a faint hint at eventual normalization. But the central bank president left the door open to backtracking. Draghi said the EU's economy is improving, but still needs support. Quote, domestic price pressures are still muted overall, and the economic outlook and the path of inflation remain conditional on continued support from monetary policy. Therefore, an ample degree of monetary stimulus remains necessary. End quote. The ECB launched its current bond buying scheme nearly 3 years ago. According to Reuters, the central bank has purchased more than 2 trillion euros worth of bonds, depressing borrowing costs and lifting quote-unquote growth. That means blowing up bubbles. Even with the slowdown of bond purchases, the ECB will continue to buy 30 billion euros worth of bonds each month. The central bank also kept open the option of raising or extending buys and promised to reinvest maturing funds for years to come. Draghi called it an open-ended program. Quote, this is not tapering, it's just a downsize. The decision today is for an open-ended program. It's not going to stop suddenly. There is still a large amount of uncertainty, end quote. While the euro plummeted like a stone after the announcement, European stocks climbed, hitting 5-month highs. Saxo Bank AS's CFO told Bloomberg Draghi's announcement was really a, quote, dovish signal, unquote. He said, markets have been doing nothing all month, and then Draghi comes up with what is essentially QE infinity. Peter Schiff often compares quantitative easing to heroin. The economy is a junkie addicted to easy money. When you take away the drug, bad things happen. Last month, Tiger Management co-founder Julian Robertson unequivocally called the U.S. stock market a bubble and blamed it on the Fed's interventionist monetary policy. I think he's right. Analysis released last year showed that more than 90% of the stock market value since the 2008 crash has been the result of Federal Reserve policy. The addict loves its drug. The ECB and the Fed are following totally divergent paths. One has to wonder how long this can last. Draghi seems to understand he can't just cut off the supply of drugs to the addict. Yellen and company seem determined to put their junkie in rehab and gradually wean him off the heroin. But if the patient goes into withdrawal, if the air comes out of the bubble and the stock market starts to tank, will Yellen or her predecessor have the guts to hold course? Or will the Fed follow the ECB and revive the QE zombie? Peter Schiff has been saying for more than a year that he thinks the Fed will ultimately sacrifice the dollar on the altar of the stock market. If, or I should say when, the bubble pops, the Fed will quickly drop rates back to zero and then launch QE4. Central bank quantitative easing is a little bit like a zombie. It dies, but it never really dies. Last month, the Nikkei Asian Review reported on a move by China that could take a first step toward dethroning the US dollar. The proposed launch of a gold-backed, yuan-denominated oil futures contract got a lot of attention in alt-media circles. We reported on it here at SchiffGold, but it didn't make much of a splash on traditional news outlets. Now, all of a sudden, the mainstream is sitting up and taking notice. During an interview with Bloomberg TV Tuesday, Graticule Asset Management Asia CEO Adam Levinson said China rolling out a yuan-denominated oil contract within the next few months will be a wake-up call for investors who haven't paid attention to the plans. The move potentially creates a way for oil exporters to circumvent U.S. dollar-denominated benchmarks by trading in yuan. The contracts will reportedly be priced in yuan but convertible to gold. Levinson said besides serving as a hedging tool for Chinese companies, the yuan-backed oil contracts will aid a broader government agenda of increasing the use of the yuan in trade settlement. CNBC also picked up on the story this week, proclaiming China had grand ambitions to dethrone the U.S. dollar. Russia would also like to untangle itself from the dollar system. Gold plays a key role in both Russia and China's plans to achieve economic independence. There's more about that at SchiffGold.com/news. In other news, a bill pre-filed in the Alabama State House would exempt the purchase of gold and silver bullion from state sales and use tax, encouraging its use and taking the first step toward breaking the Federal Reserve's monopoly on money. Republican Representative Ronald Johnson pre-filed House Bill 19. The legislation would exempt the gross proceeds from the sale of gold, silver, platinum, and palladium bullion and coins from sales and use tax in the state. Of course, this is good news for gold and silver dealers and investors, but it has much broader implications. Repealing taxes on the sale of gold and silver effectively removes taxes from the exchange of one kind of legal tender for another kind of legal tender. After all, gold and silver are money. In other words, individuals buying gold and silver bullion or utilizing gold and silver in a transaction would no longer be subject to state sales taxes on the exchange. This should encourage and facilitate the use of gold and silver in everyday transactions. This is one way we can undermine the Federal Reserve's monopoly on money. The silver-gold ratio currently stands at 76-1. This means you can buy 76 ounces of silver with 1 ounce of gold. Consider the historic average ratio hovers around 16-1, and the modern average over the last century is around 40-1. As Peter Schiff said earlier this summer, this is silver on sale. People in India seem to recognize this buying opportunity. According to the Economic Times, silver demand was up 15% during the fall festival season, even outpacing gold sales. Analysts attribute the surge in silver buying to a lack of consumer confidence in the economy and silver's relatively low price. You can take advantage of this silver buying opportunity for a very limited time. SchiffGold has obtained a limited supply of 2013 and 2014 1-ounce silver Britannia bullion coins minted by the British Royal Mint. These beautiful coins are ready to ship right now for as little as $1.49 over spot per coin. Call 1-888-GOLD-160. That's 1-888-465-3160 and speak with a precious metal specialist today. This sale will end as soon as supplies run out. Well, that's a gold wrap for this week. You can get more details on all of these stories and more, and keep up with the latest precious metals news and analysis throughout the week at SchiffGold.com/news. If you haven't done it already, subscribe to the Friday Gold Wrap at iTunes for free. There's a link on our show notes page. Thank you for listening, and I'll talk to you again next week.